In this example problem, we're going to be calculating the economic value added, or EVA, for a couple of locations at an area small business. Economic value added is a variant on residual income. It measures through a bunch of different options, in this case, different locations, how much extra value you are adding to the company beyond the required minimum rate of return that you have on your investments. And for us over here, we are going to deal with it in terms of economic dollars instead of just pure accounting profit, which means it's not just a measure of how much you increase stuff, but how much you increase it above your costs. So to do that, we're going to have to figure out what our weighted average cost of financing is, or weighted average cost of capital, as they call it, our WACC. So in this example problem, we're going to be Pedal Paradise, and we are a bicycle retailer with three locations in central New York. We have one in Utica, Syracuse, and Auburn. Company management is evaluating the economic value added by these three locations, and we have the following information to work with. Pedal Paradise is carrying $5 million of long-term debt right now. The average interest rate on their long-term debt is ugly at 16%. The total equity capital that they have on their balance sheet is 8 million. The cost of equity capital is 7%, which essentially means that investors want a 7% return on their investment to buy into the company's stock. We pay a tax rate of 30%, and we're in a really good spot right now because our current liabilities are zero. So down here, we have our information for our different companies. We have our operating income for our three different locations. We have the sales revenue generated at each of the three locations, and we have the amount of total assets that each location has. Let's start first by figuring out our weighted average cost of capital, because the formula for economic value added, while you can put it in one singular formula, has a bunch of components. And I think to understand what is going on, it's best to break it down into its components. So our weighted average cost of capital right here is what percent of the amount of financing, either both debt and equity we have to work with, are we paying in terms of charges. So let's to figure out what our cost of financing debt is. And to do that, we have the formula right here. It's 1 minus tax rate times our average debt interest rate that we have going on. So here, what I'm going to do is I want to say that this is 1 equal to, in parentheses, 1 minus our tax rate of 30%, or 70% if you will, and multiply that by our average interest rate. 11.20% is what we come up with. What does that mean? 16% is our interest rate. We'd have a 16% interest expense, which isn't good, but the one saving grace of financing stuff with debt is that interest is tax deductible. So some of that, 30% of it, if you will, is offset by the tax savings that we get. So our true cost of financing through debt is an 11.2% rate. Well, therefore, what is the total amount that we're putting through, net of those tax savings that we're paying to finance our debt? We'll just take our total long-term debt on our books of 5 million and multiply it by that cost of debt financing. And it comes out to 560,000. So after we account for the tax savings that we get right in with this interest, we're paying $560,000. It must be annually to service our debt right now. Let's go and figure out our other way we can finance stuff, which is via equity. Well, the cost of financing equity in this case is 7%. That's the rate of return on stuff that our investors expect. And we have $8 million of equity on the books. So if we have to pay out 7% of that in form of dividends, if you will, that's $560,000 a year. So now what do I get if I combine these two things together? My total combined long-term financing. Well, here I'm going to add together the long-term debt I have on the books, which is 5 million, and the equity that I have on the books, which is 8 million. So we've got $13 million that came in from elsewhere that we are using to finance our operations. And now we can find our weighted average cost of capital through this kind of crazy looking formula over here. What I'm going to do is add together my two financing amounts that I have, which is 560,000, strangely, to both of them, and divide it by our total combined long-term financing. We are paying $560,000 a year for our debt and $560,000 a year for our equity. So it's $1,120,000 per year to service the $13 million worth of capital that we have to work with. So our weighted average cost of capital is 8.62%. For every extra dollar we raise, on average, be it through debt or through stocks or whatever, we're going to have to pay out 8.62% of that back each and every year to pay interest, to pay dividends, etc. Let's keep on plugging away, getting these components of EVA together. The second thing we need is our after-tax income. So we're just going to take our operating income and multiply it by the complement, if you will, of our tax rate, 1 minus tax rate. So for the Utica location, that location had operating income of 650,000. We're going to multiply that by, in parentheses, 1 minus our tax rate, and our tax rate is 30%. So after we pay taxes of 30% on that $650,000 of operating income, we'll be left over with 455,000. For Syracuse, same jam. We're going to take our operating income, 350,000, and multiply it by the complement of our tax rate to figure out what we'll have left after we pay that 30% in taxes. So the 70%, if you will, remaining of our $350,000 of operating income comes out to be 245,000. The same thing for Auburn. Operating income of 425,000 times, open parenthesis, 1 minus our tax rate, which is 30%. So we have our operating income, our after-tax income, excuse me, for each location. Let's move on and find our capital employed, as they call it, for each location. And that is our total assets minus our current liabilities. And for our company, this is nice and easy because we have no current liabilities. So I'll be thorough and say that for Utica, they have a total amount of assets of 1.1 million, and our company has no current liabilities. So all 1.1 million is employed. For Syracuse, $925,000 of total assets, minus our $0 of current liabilities, all 925 is employed. And for Auburn, they have $1 million worth of assets. They have $0 of current liabilities. They have $1 million of capital employed at that location. I don't know quite why Syracuse is the smallest of our three locations when it's the biggest city out of three. Well, let's not think too hard about it because we have all the numbers that we need to figure out what our economic value added is for each one of these locations. So what I'm going to do is I'm going to take my after-tax income, and from that, I'm going to subtract my weighted average cost of capital times my capital employed. So my after-tax income for Utica was 450,000 minus, open a parenthesis, our weighted average cost of capital, which we determined was 8.62%, times the amount of capital employed at that location, which is 1.1 million. And it comes out to be $360,230.77. For Syracuse, our after-tax income was 245,000 minus, in parentheses, our weighted average cost of capital, 8.62%, times the amount of capital employed in Syracuse, which is 925,000. And that comes out to be 165,307.69. And then for Auburn, one last time, their after-tax income at that location was 297,500 minus the product, put an underscore in there, the product of our weighted average cost of capital times the amount of capital employed at that location. And that comes up to $211,346.15. So what does this all mean? Like, what is the purpose of economic value added? Well, what it means is that net of taxes on our profitability and net of the cost that we are paying to finance all of the assets that we're using because we purchase them with either debt or equity, Utica is generating about $360,000 more after-tax income than it is the financing cost it has to pay for the assets that they're using there. Syracuse is at $165,000 of excess, and Auburn's at $211,000 of excess. So what is the most profitable location that we have? It's Utica, by far. Utica is almost as good as Syracuse and Auburn combined because Utica is generating a much higher level of after-tax income over here compared to the assets that they have to work with. And this formula is nice to work with EVA because things change. There's variable rates that go on, the required rate of return that you have on stockholders' equity or the dividend payout percentage that you have are going to change as the market changes. So you constantly have a formula that you can use to figure out, okay, what one of our different components of that we have is actually adding value to our company.